Namaste. After my last video on the year-end portfolio review checklist, the most common question I got was, how do you exactly analyze the GST returns? And I understand it. Your customers hand you just 6 months of GST returns, sometimes 1 year like GSTR 1, sometimes GSTR 3B, GSTR 2A, and you are thinking like, what am I supposed to look for here, right? Now, here's the reality. GST data is the most underutilized tool in the credit assessment I have seen. Your customers show you a beautiful balance sheet, but GST returns, those does not lie. Trust me, they are filled with the government. They are filed with the government every month in real time, and they are verifiable. You can verify it by taking the user ID and password, and there are many other things. You don't need user and ID and password of your borrower, or you can say customer. You can directly verify from the portal. Now, hi, my name is Sangeeta Sharma, and today I'm going to show you exactly how to read GST return and catch the red flags that can save your potential NPAs. So before we start today's video, I want to give you a quick update that has recently been done. A major rationalization came into effect just on 22nd September 25, moving largely to a dual rate structure like 5% and 18% with 40% for selected say, or you may say luxury goods, and some special niche rates. Continuing, why should a credit officer care, right? Because rate changes impact your pricing, margins, demands, working capital cycles, and sometimes classification disputes and compliances risk. So I let me be clear here. For credit appraisal, you don't need to memorize these item-wise rate. Trust me. Instead, you can build a verification system what the borrower files, pays, and claims. I will explain you throughout the video. So please remain throughout the video so that you can learn. And to learn more, I would advise you to just take a pencil or a pen and paper or a notebook so that you can learn more and you can note down the important things. So let's start. Okay. So why GST is your best friend? Now, before we start, we jump into something technical. Let me tell you why GST returns have become more important than your audited financials, especially for credit officers, right? Now, audited financials are filed once in a year from March to September. They can be managed by CA, right? They represent only historical data that can be sometimes 6 to 9 months old by the time when you see it, or sometimes these are more than 1 year old, right? And you cannot verify them real time apart when they are private limited company or LLP. Then you can verify from the portal, MCA portal. But when they are just proprietorship or partnership, it's very difficult for you to verify them, right? Now, let's talk about GST return. Now, GST returns are filed monthly, sometimes quarterly, right? By 11th and 20th of next month means you can know the sales of previous month, right? And they are directly with the government, and they are uh, really hard to manipulate, right? They are almost in the real time. Sometimes just we can say they are 10 to 20 days only old, and that is completely acceptable, right? They can be verifiable on portal. You can directly verify them, and they show actual business transaction, right? Now, I have had clients who show me 2 crore annual turnover in their balance sheet, but when I checked their 6 months of past, only 6 months GST returns, their average monthly sales were only 8 to 10 lakh, and when you calculate it, that's only 96 lakh to 1.2 crore say annually, not 2 crore, right? There is still a differential of 80 lakhs. That's huge, right? And that's, I call it 40 to 50% inflation. And this is not rare, right? It's completely common. We have seen many examples of this. I'm sure you, if you are watching this video, you have seen this in your day-to-day banking career, right? Now, according to RBI guidelines on credit appraisal, GST data must now be part of your due diligence, and it's not optional anymore. So Whenever a customer or client comes to you, just ask them their GST returns, right? And this will also help you, right? Now now let's understand the three critical GST returns. Let me break down them into three returns so that you can focus them what you need, right? Now first is GSTR1, return 1, that is outward supplies. Now what in this GSTR1 shows you, they show you sales and revenue that is completely declared by your customer. So what are the key sections you can check? Now B2B invoices, right? Section 4A, 4B, 6B and 6C. Now 4A, how you see in this, see this is a sample GSTR1 of my one of my clients. So GSTR1, this here you will find the section, this is 4A, this is 4B, this is 5, this is 6A and this is 6B, right? Now you can just take a sample of your customer or client and you can check there, right? Now just 4A, 4B and 6B and 6C, they show business to business sales with buyer GST. You can verify if your buyer actually exists or not. These shows invoice level detail, right? Now B2C, that is 5A, 5B and 7 number, right? This I am telling you because business to business transaction, business to customer, so that you can easily verify. When a customer tells you, you can tell them what type of business they are doing, right? Now B2C invoices 5A, 5B and 7, they tell you retail cash sales, less, they are less verifiable, but they show cash business transaction. Now what are you looking for? You are looking for total taxable value, that is equal to their sales, right? You can match this with their bank deposit. This is much more important, your bank statement, right? You can check them what are the credits and you can just match the sales and credit, right? Check if the major customers are repeated. If it is repeated, this is a good sign, or one time it is, then this is completely risky, right? Now here's a pro tip from me for trading businesses. If 80% of the sales are B2C, then trust me, this is a red flag, right? Because they are selling to small customers, not the major, right? Because these cash sales you cannot verify and they are easier to inflate. Customer can inflate them easily, right? Now let's move forward. Let's learn the return number 2, that is the most important, GSTR3B. These show summary return and tax payment. Okay, now what it shows, monthly summary and how much tax actually you have paid, right? Now this is the most important return for the credit officers. Now table 3.1, this one we are talking about, this table, this shows you outward supply. Now total taxable value equal to sales declared. Now this is the total taxable value and now this is the sales. You can simply add, you can make Excel and you can put this value there. And now ICGST, CGST and plus state GST, these are the total tax liability. Now let's go to table 3.2, that is this one. Now this table shows input tax credit, that is the ITC claim is equal to tax on the purchase, right? Now this indirectly shows that what is the purchase value, right? This you can see it here. Okay, now table number 6, section number 6, what is this? Section number 6 is payment of taxes. Now did they actually pay the tax? You can verify it from here. Whether this was cash payment or versus ITC utilization, this all can be checked through here. Now these are the ITC tax paid and this is the tax paid in the cash, right? Now just here's a quick formula. You can say gross sales, that is table 3.1, minus purchases, that is reverse from ITC. This will be equal to your gross margin. Now if this margin looks weird for the industry, then you know it, this is a red flag. Let's take example. I just remember example of textile trader in Surat. His table 3.1 showed 40 lakh sales and ITC was 6 lakh. Let's assume the GST was 18%, and now when we do the reverse calculation, the purchase was 33 lakh. So when we calculate the gross margin, it will be 17.5%, that is 7 lakhs. Okay, now for textile trading 8 to 12% is normal, right? But 17.5%, either they are very efficient or that there is something wrong, right? We can just get a quick look from here, and then we can investigate it deeper. Now let's move to third return, that is GSTR2A. These are auto-populated purchase register. These are the purchase declared by the customer's supplier, or you can say your supplier. Now these are critical. It's not filed by your client, right? It's just auto-generated from what their suppliers declared in GSTR1. Means suppose uh, from whom they have purchased, they have filed their in GSTR1. So this the system auto-populated from there, right? GSTR2A. Now your client's GSTR3B ITSC claimed is suppose 5 lakh, then GSTR2A what their supplier declared is say 4.2 lakh, then the gap is 80 lakhs, right? Now sorry, 80,000, sorry, 5 lakh is GSTR 3B value, and GSTR 2 is 4.2, then the gap is 80,000. Now what does this mean? This means your client is claiming ITC on purchase that supplier did not report, or maybe he has reported some possible fake invoices, or maybe there is something wrong, his supplier have not yet filed. Now these can be risky vendors, right? Now, for manufacturing businesses, GSTR to a mismatch of more than say 10% is a major red flag. It either means fake billing or maybe unreliable supplier base. And when you see this is a red flag completely, right? Now, here's my 8-point GST analysis checklist. Now, let me tell you how I do, and I think this will take hardly 10 minutes once you take it, start understanding it. It's just take 10 minutes, and I think you can use it just to save your potential NPA. This is very easy, right? Now, first is filing compliances. Checklist number 1. Now what you can do in this is what to check. Just go to GST portal, go to that is gst.gov.in. I hope all know gst.gov.in. This is GST portal. You can just tap on Google, or you can directly go to the web address. Now you have to go in search your taxpayer, search by GSTN. If you don't have GSTN, you can also check by PAN number. So when you type your GSTN number, the screen will be auto-populated, and now there you can see show filing table. You can click or show filing frequency. Now here you can see how your customer has filed the GST returns, right? Here are the see, you can see here they have filed for every month. Are they late or are they regular? You can check everything from here, right? Now so let's just review it quickly. You can check his last 6 months, all returns are filed on time. If there is any late filing, this shows that there is a cash flow stress, and if the nil returns are filed, then they maybe the business has stopped, so you need to look it. Now what are the red flag pattern you can check? So suppose say in January 2025 it is filed on time, in Jan it is filed on time, in Feb it is filed on time, but in March it is filed late. Instead of 20th, they filed the return on 25th. In April they filed more late on 28th, and in May they have not filed yet. So this shows that their cash flow is tightening. They are delaying the filing because they cannot pay the tax. So you need to just have a look and just learn it and just cautiously check, right? Now let's go to check number 2. Sorry, revenue trend analysis. Now I have taken here three scenarios. First is healthy growth, declining trend, and erratic pattern. Okay, to understand it easier, so you can pull the data of 6 months, and then you can make an Excel sheet, and then you can check it. So let's go to healthy growth. 35, 38, 42. This is continuously increasing, right? This means that there is steady upward trend with minor seasonal dips, right? And definitely if the sales is increasing, then this business is healthy, right? Now let's take scenario number 2. Scenario number B, declining trend. Say in October the customer filed just a return of 45 lakh, then it reduced to 42, 38, 35, 32, and in March it was just 30 lakh. This means consistent decline means businesses in the stress, and you need to look. This is a red flag for you. Now let's go to scenario number C, erratic pattern. In October it was 25 lakh, in he filed return for 50 lakh, then again December it dropped to 20 lakh, then in January again 55 lakh, in Feb 18, then in March suddenly 60 lakh. There is no pattern, right, in the sales. Now there is a possibility that this is a seasonal business, or maybe the data are manipulated, and this shows yellow flag. Okay. Now check number 3, cross verify with the bank statement. Now this is where maximum frauds are get caught, right? So let's take an example. In March someone filed the GST return of 50 lakh, and his B2B business, and his business type is B2B, business to business. This is a manufacturing unit, and they get approx 30 to 60 day credit, and but in bank statement they show 55 lakh deposit. Now what to expect? Let's say March sales are 50 lakh, this won't hit bank in March, right? If he has sold in B2 businesses, usually the sales is on the credit basis. So February sales is 48 lakh, this should hit bank in March, right? Now if the bank deposit of the previous month does not match the GST sales, and if there is variation of more than 20%, maybe increase or decrease, then you need to look more, right? And just remember, let's take a case of AB Pharma distributor. They showed a GST data of 40 lakh monthly sales consistently now, but the bank deposit was only between 28 to 30 lakhs. Now the question is, where is the difference amount 8 to 12 lakh? Now it turned out when we dig deeper that cash sales were not being deposited, they were diverted for the personal use, right? Now when we asked for 2 years of old GST and ITR data, this mismatch was confirmed, and since the funds are being diverted, then there is no point in sanctioning the loan, and it was immediately rejected, right? Now let's move further to check number 4. It's B2B versus B2C, means business to business versus business to customer ratio. Now for different business type, the ratios should make sense, right? Now let's understand this. For manufacturing, majorly manufacturers always do B2B sales, and their expected B2B sales are 80 to 95%, but B2C they are just 5 to 20%. For wholesaler, 70 to 9%, 70 to 90% we can expect B2B sales, and for B2C they are just 10 to 30%, right? But again, for retailer the B2B sales will be less, that will be only 20 to 40%, right? But business to customer, since they are retailer means you can say some shop or maybe some mall, their expected B2C sales will be 60 to 80%. Now when we go to service provider, their expected B2B sales is 60 to 80%, and expected B2C sales is 20 to 40%, right? Now what are the red flags? So, say suppose example, client claims B2B, suppose he is an auto component manufacturer, and GSTR1 shows the report that B2B sales are 45%, but B2C sales are 55%. Now who's buying auto components in cash or retail, right? Auto component parts, who will buy in cash or retail? No one, right? Only very few. So this means that either they are selling to unregistered dealers, that is high risk. Maybe they are inflating B2C to show more sales, fraud, correct? Now business model is different than claim, correct? There can be any of these three, so this shows completely red flag. Okay, now let's go to our check number 5, input tax credit, that is ITC pattern. You can check from here. Say Formula to calculate purchase value is ITC claim divided by GST rate. You will get the approximate purchase value. Right now, ITC claim in GSTR 3B say supposes 9 lakh. Let's take an example. ITC say 9 lakh. Now let's assume GST is 18%. Then what will be the purchase value? ITC claim 9 divided by 18%, right? It's equal to 50 lakh. Correct? Now sales from same return 65 lakh. The sales in GST 3B, the customer source sales is 65 lakh. Now what is the margin here? What is the gross margin? 50 minus 65, 15 lakh. Correct? Now that means there is a 23% margin. I hope I am clear, right? Now you can ask, is this 23% margin, gross margin, normal for this type of business? Here I'll give few examples of the businesses. Gross margin, say textile trading have 8 to 12%, auto components have gross margin of 15 to 20%, pharma distribution companies have 4 to 8%, FMCG have 6 to 10%, and electronics have 8 to 15%. Okay. Now, if the margin is significantly higher, either they are very efficient, that is very rare nowadays, right? And then the second case, maybe they are inflating the sales, or maybe they are under reporting purchase value, that is the fake ITC. Okay, you have. Now let's go to check number 6, GSTR 2A versus GSTR 3B reconciliation. Okay, now this is very advanced but very powerful. Okay, your client GST 3B, GSTR 3B ITC claimed is suppose say 8 lakh. Okay, now GSTR 2A value is 7.2 lakh in ITC. The difference of 80,000, that means 10%. Now what does this 10% mean? Say, suppose if gap between your GSTR 3B ITC claim and GSTR 2A says less than 5%, then this is counted normal, maybe timing difference or maybe some pending invoices, right? Now, if this gap goes between 5 to 10%, then this can also mean that this can also be acceptable. But we need to just open our eyes and ask for explanation from the customer. Now, if this gap goes more than 10%, this is the red flag. Maybe the customer is filing fake invoices. And if this gap goes more than 20%, then this is major red flag. You need to stop the loan process right here. Just let's take an example. A steel trader in Delhi, he claimed ITC of 15 lakh monthly, right? But when we checked their GSTR 2A, it shows only 9 lakh. The gap was huge, 40%. That is huge. When we investigated the matter, they revealed that they have put the 5 suppliers fake. They were fake entities. Now, they were not just creating the fake bills to inflate, they were even claiming ITC. And when we checked that the loan application was rejected, no need to process the further, right? You know the customer intention is wrong, right? Now let's move to the next check, tax payment pattern, check number 7. Okay, now see, in check number 7 we are taking the we are taking this GST. This is GSTR 3B, GST 3B. Okay, now we will go to 6.1, that is tax payment. This GST 3B shows table 6.1 shows the tax payment pattern. Okay, now see, we are here 6.1. What we have to look, tax paid in cash and tax paid through ITC. And what you are looking for, healthy patterns are here. If the total tax liability is say 10 lakh paid by ITCs 7 lakh, that is 70% of the total tax liability, and paid in cash is 3 lakh, that is 30%. And the tax payment date is 20th of the month, that is on time, correct? Then this shows healthy pattern. Now let's go to stress pattern. If the total tax liability is 10 lakh and the customer is paying via ITC say 9.5 lakh, that is 95% of the tax. Now the tax paid in cash is 50,000, just 5%, and tax payment is delayed. which is obviously delayed, just maybe 28th, the last minute. Now, what does this tell? The stress pattern, what does this tell you? That they don't have cash to pay the tax. Yes, because they are paying only 5%. They are maximizing ITC to avoid cash payment. There is last minute cash payment means last minute tax payment means cash flow stress. So you need to dig deeper in this, right? Now, if a business is consistently paying less than 20% of the tax in cash, it means they are barely generating the margin and all profit is going into ITC, and that's not sustainable, right? Now let's move to the last checklist, that is check number 8, notice versus demand, notice or demand history. So when we log in the GST portal of the client, you can see here when we go to dashboard, you can see the notices and orders here, right? Now what do you check for? Any GST notices received, or maybe any demand orders, or any penalty or interest is charged or not, or are there any audits conducted? See, if there are no notices in last 2 years, then this is a green signal, good to go for you. If there are 1 to 2 minor notices, then you need to take clarification from customer. And if there are multiple notices, demand orders or audit underway, then this again a red flag. This is the risky, right? Now, why this matters? If your client is under GST scrutiny, say, then it means department suspects irregularities, right? There may be possible tax demanding pending. If the demand is raised, their working capital gets hit. That's true. And your loan might be used to pay GST dues, and that means the fund diversion. Always ask your customer, do you have any pending GST notices or demands? And if they hesitate or say minor issue, then you need to look more into it. For this, we always used to take annual statute dues from the customer CA with UD number. This also told us, because CA, they always, when they put UD number, they always check that if there are any pending notices in their PAN card or GSTN or any statutory dues, this will save you, right? Now, here are some industry specific GST patterns. And that different industries have different patterns, right? Now, here's what to expect. Manufacturing, they make and sell. Now, expected patterns are high ITC, right? Raw material, because they purchase. Steady monthly sales. B2B domain is must. I have already told you. Now, GST rate are usually 12 to 18%. So, right? Now, what can be the red flag in this? There is sudden drop in ITC. Maybe they have stopped the production. If there is increase in B2C, then question, who's buying manufactured goods retail, right? If the revenue spikes without ITC spike, then this definitely means inflated sales. You need to look, right? Just say, let's take an example of plastic manufacturer. Their sales is, say, suppose 60 lakh per month, and their ITC is 8 lakh per month. This implies that 44 lakh purchase, right? At 18%. Now margin is 16 lakh, that is 26%. Now for plastic manufacturer, 26% margin is too high. Standard, we can say, is 15 to 20%. You can question them, right? Are they inflating the sales or underreporting their purchaser? Correct? Now let's move to another industry, that is trading. They buy and just sell. Okay. Now what are the expected pattern? They're moderate to high ITC, right? That is a purchase of goods. Now thin margins 5 to 15%, mix of B2B, B2C depending on their segment. And there is fast turnover. Check monthly, you can check their monthly consistency. Now what are the red flags? Margins above industry standard, large B2C component without retail presence, and ITCs versus sale does not match. That is working capital mismatch. Correct? If this does not match, then clearly means you need to look for it. And here I can tell you an example of electronics wholesaler. His monthly sales were 80 lakh, right? But his ITC claim were 12 lakh per month. That implied that he was purchasing goods at 66 lakh, and the GST percentage was, I think, 18%. Yeah. So when we calculated, the margin was 14 lakh, that's 17.5%, right? For electronic wholesale, this is high, but we can accept. But if it was more than 20%, say 25%, then that would be a red flag for us. Now let's go to next industry, that is services or consulting IT. So what are the expected patterns? Very low or zero ITC. Why? Because there are no goods purchased, right? They are service industry. High margin, 40 to 60% is completely normal for them. Their pattern is almost 100% B2B. If it is 80 to 90% acceptable. GST rate is generally 18% in the service industry. Now, what are the red flags? High ITC. If they are showing the ITC and that is too high, then that's a red flag. If they are showing their B2C client are in majority, then that is also a major red flag, because no one buys consulting in cash, right? And if there is erratic revenue, unless this is project based, then this is also red flag. And just take an example of IT service company. Say suppose their sales in monthly sales are 50 lakh, then ITC are say 50,000 per month, right? Just they are paying office rent or maybe utilities, then that makes sense, right? Maybe they are purchasing stationery, that is also sense. And now when we check the sales to ITC ratio, the margin is gross margin 90%, completely acceptable, right? Because they are not purchasing anything, they are selling the service. Now this is healthy. Now if this ITC was sales for 8 to 10 lakh, then we could question them, right? What inputs are they buying, correct? Now let's go to next industry, that is contractor and builders. So what are the expected pattern? You can see is project based lumpy revenue, high ITC, since material and subcontractors there are many, right? Long gaps between revenue project milestone, right? If you have seen any contract order, you must have seen that there are they will get the amount only when they specifically complete a milestone. So long gaps are completely normal in revenue, and GST rate are just between 12 to 18%. Now what are the red flags? The two consistently monthly based projects are not that steady. Because the contractor or builder, they are never having the consistent monthly sales. Now zero ITC despite material supply contract, right? If they are filing zero ITC, but they are purchasing material from somewhere, right? So how can we zero ITC? Now subcontractors payment not matching, red flag. I just remember a construction contractor example. He was in Faridabad. His monthly sale was 15 lakh in January. February it was almost zero. In March also zero. But in April it reported 80 lakhs, and in May it was I think 20 lakh. Yeah, 20 lakh. Now this is normal for contractors, right? If you see in some month zero, there are some construction customer, they have 6 months return zero, but after in the later financial year they get their whole amount. Not, that is also completely normal, because these are based on the project timeline, right? Now since our specific industry specific GST patterns are completed, let's quickly go to the red flag summary. Now just let me give you the quick this reference. Okay, now critical red flags. If you are seeing these red flags, then please just stop the loan. No need to just go for second thinking or explanation. See, if suppose a customer has not filed the GST return for more than 2 months, consecutive months, then this business might be at the edge of shutting down, right? If the GSTR 2A gap is more than 20%, that clearly means they are fake invoicing, right? If the sales are declining more than 40% continuously over 6 months, then this also means business is dying. If there are multiple GST notices or demand, maybe the business is in legal trouble. And if the tax payment via ITC is more than 90% consistently, that means there is no cash in the business. And if margin inconsistent with industry by more than 50%, this clearly means this is a manipulated data. Now let's go to warning yellow red flag. These yellow flag means that you need to investigate further. You need to call for explanation from the customer. Say suppose customer has filed late GST return for past 2 to 3 months. This may include that the customer is facing cash flow stress, right? Now, if the GSTR to a gap is 10 to 20%, there might be slight issues. You need to check them. If there is erratic revenue pattern, you need to ask for explanation. Correct? If B2B versus B2C does not match the business need, that means the customer is not clear about the model of his business. Now, if the bank deposit does not match GST trend, there is a possibility of diversion. You need to investigate it further. You need to take the proof from the customer. Now, let's quickly go to green flags. These are the healthy signs. If these signs are there, just yes, just go for the process further from my side. So, if the customer is consistently filing his return on time for more than say 6 months, that clearly shows the customer is disciplined about his financial. If there is steady or growing revenue, business is growing, margins align with the industry, then that means the customer is showing the realistic data. If GSTR to a gap is less than 5%, that means customer is doing clean purchases. And if tax paid in cash is 20 to 30%, then that clearly means the business is generating cash, right? So here's my practical workflow. And this hardly takes 10 minutes to analyze the GST return. You can do it too, right? Just get the document, ask your client for past 6 months GST 3B summary, and you can also ask for GSTR1 just for past 2 months so that you can check the details. From there, you will get the GSTN number. Just log into GST portal, search their GSTN, check for their registration status. Is it active or not? If there were any notices, if the addresses were changed, you can check all of this. You can check their filing compliances score. You can check for their notice invoices. Also, here I would like to mention one point. You can just, it will hardly take with some seconds, just check the pan. Through pan also check the business, because sometimes there are that the customer want to divert his money. He has in single pan he has registered 2 to 3 businesses, so you can check so that in future you can check for the diversion, right, of the funds. Now step number 3, let's go to step number 3, right? Since you have checked everything about GST, you have verified the basic data. So now it's the time you need to prepare a simple Excel sheet, like this way month you can put then sales as per GST 3B, then ITC, implied purchases, then margin, bank deposit. If they are matched, then yes, correct. Now what you are looking here is if there is any declining sales trend, or maybe sudden margin spikes, or maybe drops, or maybe bank mismatch, correct. You are checking only this. Now, if you have checked all this, then you can go to step number 4, industry benchmarking, which we talked in earlier part of video. You can compare their margin with industry standard. When I talk about margin, that means gross margin. You can check if this B2C or B2B ratio makes sense for this customer. You can verify tax payment pattern, right? Now, step number 5, document findings. You can note all the red flags, yellow flags, prepare the question for your client, and the last step is just add all of this in your credit note, because no one remembers what you wrote 2 years before or whatever, right? So just document all of this. Now GST analysis 6 months reviewed. You have revenue. Your revenue trend is stable. Your margin are at 14%. That aligns completely with your industry, right? Now GSTR 2A reconciliation shows 6% variance. No notices filing. Compliance is 100%. That's a yes. You can approve the loan for further processing. Correct. Now here is another slide. Now what to ask? What do you want to ask your customer, right? This is a common question. So if you find any red flag, then please don't say that, "How, sir, your GST return does not match. I think you're committing fraud." Please don't say it. He will complain against you. So just say, "Sir, I have reviewed your GST patterns and noticed few things. I would like to understand. Can we meet or can we discuss at your premises, or maybe you can visit the bank, right? Now here is my top 5 question framework that you can also use to ask your customer, right? Question number 1, filing compliance. Sir, I noticed that your March GST return was filed late. I hope everything is okay with your cash flow. Now, why you can ask this way? Because this will open the door for them to explain without feeling attacked. They will explain, maybe there might be some health issues, maybe something in their house, right? Or maybe they forgot anything, right? You can just, this opens the door for friendly conversation. Now, question number 2, revenue trends. Sir, I see your sales drop 50 lakh to 35 lakh over 3 months. I hope everything is okay. What is causing this? Is this seasonal or something else, right? Now, why you ask this way? Because seasonal drops are fine, but when we talk to business problems, they are never fine, right? Question number 3, on margin analysis. Sir, your gross margin looks like 25%, which is just higher than your normal industry standard, that is 12 to 15%. What's your competitive advantage? Now, why you should ask this way? Now, if they can explain you legitimate efficiency, then that means great. But if they stammer, they are taken off, then that means there is something wrong. You need to investigate further. Now, question number 4, which I during my career found this most bank mismatch. So your November GST shows 45 lakh sales, but I see only 32 lakh deposited in your account in November. Can you help me understand what is the timing here? Now, when you ask this, maybe the sales were on the credit period, right? Or maybe it's diversion, and their explanation will tell you everything, right? Now, question number 5, ITC gap. Sir, I see a 15% difference between your claimed ITC and what's showing in GSTR 2A. Can you help me reconcile this? When you ask this way, now, if they have proper documentation explaining the gap, then it's no problem, right? Customer will tell you, sir, this is the code. They must be having documentation, right? Now, if they don't have the documentation, then this is major red flag, correct? Always remember that good clients will always have answer, and stressed client will just get defensive. But the fraudulent client, they will get aggressive, they will start making excuses, and they will just start shouting. So your job is not just to accuse anyone, it's to understand. Let their answers guide your decision, and that will make it simpler for you, right? Now, here are some tools and resources you can use that will be useful for you. Say GST portal, which I told you already. You can just go without logging in and check many of the things, right? A few Excel templates, you can create your own as depending on your need. Industry and margin databases, CRISIL reports, industry association data, and most importantly your bank's industry report, right? And civil bureau, everyone check this, right? You can cross-reference GST with bureau data, check if other banks show the same GST, right? Here are a few resources that I use. RBI Master Circular on Landing GST Verification Guidelines, ICA GST Audit Guidelines, and your bank's internal credit policy, which you can also use, right? They're completely free. You can just log in, or you can just go on to their website and check them, correct? So we are here. All right, so there you have all the complete GST guide to analyze GST returns just like me. So look, I know this seems like a lot, but here's the truth. Once you start doing this 5 to 10 times, trust me, it will become your second nature, and you will be able to spot the red flag just in 5 minutes, hardly 5 minutes. And this skill will save you from potential NPA. I have personally stopped many loans that would have gone bad just by catching these GST red flags that the balance sheet does not show us, right? Now, GST data is a real time, it's verifiable, it's harder to fake than financials. Just use it, make use of it, make it your first check, not just your last check. Before you go, I want you to download my GST analysis template. Link is in the description box. Take your just last 3 loan files, pull their GST data, run the 8-point checklist, and see what you find. You might be surprised, and if you find anything, just mention the comment box and let's discuss it. And if you find this video helpful, helpful for you, hit that like button, subscribe it if you haven't already, and please drop a comment. Tell me what's the biggest GST red flag you have got, and if you think this video can help anyone, just share with them. Until then, stay sharp, trust the data, and keep your portfolio healthy. Thank you. Thanks a lot for watching this video.